Okay, let's jump straight into today's explainer. We're putting a magnifying glass on a stock that literally defines the phrase tug of war in the market right now. I'm talking about UnitedHealth Group, ticker symbol UNH. Now, you probably already know this healthcare giant. Honestly, there's a good chance it's sitting right there in your retirement portfolio. But right now, it's perfectly capturing this wild tension between absolute powerhouse financial results and, well, some seriously severe governance risks. It's like watching a split screen. You've got soaring profits on one side and these really dark, looming legal clouds on the other. So that brings us to the million-dollar investor question. Is UNH a ridiculously compelling entry point right now, or is it a classic value trap? To figure that out, we have to choose a lens. Is this current stock price just a beautifully discounted chance to grab a fundamentally strong business, or is that discount actually a giant flashing warning sign for hazards dead ahead? To get to the bottom of this, here's our roadmap for the explainer. First, we'll look at the market crossroads, then we'll dive into the bull case, followed by the bear case. After that, we'll weigh the risks and finish up with the exact signals you need to be watching. All right, Section 1, the bull case, focusing on operational strength and financial performance. Let's kick things off with the positives, because honestly, they are absolutely massive. Just look at this number, 56.4%. In the second quarter of 2026, UNH reported a jaw-dropping 56.4% year-over-year earnings increase. We're talking adjusted earnings hitting $6.38 a share. That kind of growth comes from ruthless cost management and just stellar execution across all their key divisions in a pretty complicated healthcare landscape. When you're an investor and you see a company of this sheer, massive size growing at that kind of velocity, that is exactly what you want to see in a core holding. And the wild part? Management is totally banking on this momentum keeping up. They're so confident, in fact, that they raised their full-year 2026 adjusted earnings guidance to a range between $19.50 and $20 a share. But wait, it doesn't stop there. If you look at Analyst Consensus, they're forecasting earnings to just keep climbing, averaging $22.42 in 2027 and reaching a towering $26.22 by 2028. The core business here is, quite literally, a compounding machine. Wall Street is definitely taking notice of this engine. Right now, there's an overwhelming buy consensus with an average 12-month price target of $475.23. Out of 27 surveyed analysts, the bullishness is just palpable, representing an upside of over 20% from recent prices. Major players like Bank of America and Bernstein have actually recently upgraded the stock or bumped up their price targets. They're specifically pointing to improving margins and a really strong outlook for UNH's Medicare Advantage business. So up to this point, the picture looks absolutely pristine, right? Well, let's pivot to Section 2, the bear case, specifically the governance and legal storm. Yeah, here is where the story gets incredibly complicated. Despite those soaring earnings we just talked about, the market is slapping a heavy governance discount on the stock. UNH has been hovering in the $393 to $420 range, which is way below its 52-week high of $461.62. Why? Because of a rapidly growing list of legal and regulatory headaches. To understand this discount, we need to cut through the legal jargon. There are 3 major derivative lawsuit allegations, basically forming a direct challenge to the company's leadership. Now, just for context, a derivative suit means shareholders are stepping up to sue the executives and the board on behalf of the company itself. And the core of this challenge alleges that the board completely ignored severe internal warnings for years. We're looking at the cyber catastrophe, Medicare fraud allegations, and the $11 billion shock. Let's break these down one by one. First up, the cyber catastrophe. Look at this number, 190 million people. The lawsuit claims that after UNH acquired Change Healthcare, the company actively downplayed massive cybersecurity vulnerabilities, and they allege this negligence directly led to the 2024 cyber attack that impacted approximately 190 million individuals. Let that sink in for a second. With a scope like that, we are literally talking about the largest healthcare data breach in U.S. history. But the financial hits don't end with cyber risks. The suit also claims the board internally figured out the financial impact of new Medicare risk models all the way back in 2023, and their estimate? A staggering $110 billion hit over 3 years. The allegation here is honestly kind of wild. They allegedly chose to hide this massive risk from investors, just tucking it away alongside an already acknowledged but much smaller $11 billion impact. Okay, and it gets even more serious with some really troubling Medicare fraud allegations. The suit claims UnitedHealth actively shut down an internal audit program that had specifically flagged billing problems. And this follows separate allegations about manipulating Medicare payments to inflate revenue. These aren't just empty claims either. The U.S. Department of Justice is actively digging into this, with both criminal and civil investigations happening right now. All right, moving into Section 3, valuing the risk, a market divergence. So we've seen the massive earnings, and we've seen the severe allegations. The market is constantly trying to price this intense tug of war. UNH is currently trading at a PE ratio of 21.13. Now, while 21 times earnings isn't exactly bargain bin cheap for the broader market, for UNH, historically, it's notably cheap. The market is basically acting like a giant weighing scale right now. And this divide is playing out fiercely on Wall Street. You've got bullish analysts targeting $490 or more, pointing to successful AI integration and massive margin recovery. They firmly believe the core business will easily outshine the legal drama. But fighting them are the skeptic analysts, targeting a mere $197. Firms like TD Cowen are citing weaker core growth prospects, intense regulatory scrutiny, and a really vital detail the CEO actually admitted to recently: stubbornly high commercial medical costs that are rising well above expectations. Which brings us to our final section, outlook and key signals. Ultimately, you have highly profitable core businesses acting as the backbone of the U.S. healthcare system, directly clashing with this perpetual cloud of DOJ liabilities and an acknowledged $11 billion financial impact that's going to weigh on earnings for years. So how do you actually navigate this? Instead of just passively analyzing, here is a quick two-step checklist of the signals the smart money is tracking right now. Step 1, monitor those earnings calls. Any official quantification of legal and remediation cost is absolutely critical for modeling the true future value of this stock. Step 2, watch for settlement news or court rulings. Markets absolutely hate uncertainty. A settlement is going to be a massive catalyst for the stock, one way or the other, simply because it finally provides some desperately needed clarity to that governance discount. Which leaves us with this final provocative thought. Do you believe in the long-term story enough to endure the bumpy ride? It's the ultimate test for an investor, weighing massive, undeniable operational upside against deep structural governance liabilities. Can they fix the governance and close that valuation gap? Or will the legal risks turn this into a textbook value trap? The numbers are undeniably strong, but those storm clouds are undeniably dark too. That's all for this explainer. Keep your eyes on the data, watch those key signals, and never stop questioning the consensus.